Welcome to Books the Biz, the show where real-world business meets real-world results. Hosted by business strategist Dan Paulson and veteran CFO Richard Beltry, this podcast breaks down the stories, trends, and financial insights shaping today's companies. Dan brings decades of experience helping leaders simplify operations, build strong cultures, and scale with confidence. Rich adds his deep financial expertise from guiding organizations across healthcare, construction, logistics, and professional services. Together, they dig into what's really happening behind the numbers and what it means for owners, executives, and anyone trying to grow a stronger, smarter business. This is practical conversation, real talk, and tools you can use right now. Welcome to Books the Biz.
Hello, and welcome back to Books the Biz. Rich, welcome back as always. How are you doing?
Doing well, Dan. How are you?
I am doing good. Of course, I'm not in the middle of tax season and dealing with all that crap, so life is good for me. How about you?
It's going fine.
It's going fine. Pour me another bourbon, damn it. All right. Well, we talked last week about entities and what you should look at for entities. And for example, an S Corp might not be the best situation for you. At the end of that discussion, we started talking about a multi-entity situation. And I thought that would be interesting to dive into, not because we haven't done so in the past. In fact, I believe about, a month or two ago, we did talk about a multi-entity situation and where it might not have been such the best choice for that individual to implement. Well, that's kind of changed now due to some new information. But as we were talking last week about multi-entities, sometimes it makes very good sense to do that. So we're not going to contradict ourselves here, but we're going to explain where it makes sense versus where it doesn't. And again, this is probably going to be more your show this time than it is going to be mine because you deal with these entities a lot more than I do. But why don't we dig into that? Let's talk about why would somebody ever want to be a multi-entity, especially if maybe you want to refresh them on what we've talked about in the past where it didn't necessarily make sense and why it would make sense now.
I think the one that we talked about that didn't quite make sense was there was a structure put in place that inserted a C Corp. And when they inserted the C Corp into their structure and into their workflow, the goal was to put all of the employees on the C Corp, because the nice thing about C Corps is they have better ability to pay benefits. If you look at certain rules on S Corps, LLCs, there are things that get blocked. Owners in an LLC or owners in an S Corp can't use Section 125, which is a tax-free or a
pre-tax.
Pre-tax. Sorry, I said it wrong. Yeah. So the pre-tax health insurance, everybody's under one of those 125 plans. That's how you're getting the pre-tax on your benefits. When you're getting paid, you're not paying tax on your health insurance. So the entity sort of made some degree of sense in our case to put that in because you can get more benefits out of that. Problem was the entity that was, given this structure wasn't quite big enough. There has to be a growth plan or an understanding to go further because the administrative costs, you just added another company, you added another entity. And now someone has to track the difference between the two and understand where costs are supposed to go. And it gets very confusing for people. So that workflow is just as important as the administrative costs. Like those evaluations have to be thought through. And in our case, we were complaining a bit because, of course, he paid less taxes because he paid more administrative cost.
Right.
So you paid for the deduction and that doesn't really work for people. So I think in that case, that's what we were talking about, that, maybe this doesn't make any sense. There's plenty of other areas, though, where it can make sense. And I say can because everybody's individual. Don't go and do, as I always talk about, don't go to the water cooler and the guy down the lane comes to the water cooler at the same time and says, my guy says you have to do this. And then you follow that advice. He doesn't know you. Like, he doesn't know what your situation is. So don't just go to the water cooler, walk through the whole conversation. I think there's plenty of other situations where nowadays, and I'll tell you quickly what the, things I think are the ones that came up that basically say it's no longer the conversation from years past where it was, C Corp or an S Corp. I mean, that was basically it. LLCs came in, I think I said last week, I said it came in 20 years ago. I think it's 30 years now.
Yeah.
I have to add a couple of gray hairs and say, this is what it was. But I think LLCs came in, and then the clarification of how the IRS is going to treat, the LLCs, which was later. That came out later than the actual LLCs came out, where it said if you're a single member LLC, you don't file a separate tax return. It's part of the owner. So that created a whole lot of additional structures that could be created to provide legal protection first, which is always the first.
Right.
And then the second one is that not only gives you legal protection, it gives you an advantage to figure out how you want those workflows to go. Single member LLCs were never discussed before. Now they're discussed practically every day. So it's usually, if you're reading anything and it says single member LLC or disregarded entity, those are the two that get involved in the conversation over multi-entity structures. We thought we were being extremely, smart when we came up with what I used to call the mothership concept. So you'd have a holding company, and then each one of the pieces that you were doing had a separate entity underneath, and the mothership would then be, supporting all of the additional pieces. Okay. But the additional pieces didn't have to file a tax return because they only had one owner. So they all collapsed into the holding company and we filed one tax return. Like, how great is it to be able to tell people, look, I can give each one of these entities separate liability protection. Your lawyer would agree. And then we only have to file one tax return. It's like, I just gave somebody, a Christmas present.
Yep.
So it's one of those things where you just start having these conversations that are more advanced that you wouldn't have had before because it costs too much money.
So when a company or an owner looks at what justifies a multi-entity corporation, whether it's, for example, what we started out with, where you bring in the C Corp because that provides more employee benefits and things that you can't do in an LLC or an S Corp. Now you brought up something a little bit different, which was forgive me if I get this wrong, but there's essentially a central holding company, which could be an LLC, and then there's LLCs underneath it that all report into that. So you're only filing through the primary holding company, but each of those LLCs have their own protection, which prevents, if something happens in one LLC, from corrupting the others, assuming they've done their taxes right and they've protected that separation of organizations there. So what should somebody really be looking at when it comes to trying to figure that out, whether it makes sense to do a multi-entity or whether they should stick with the simple stuff, which we were kind of talking about last week?
Well, I think that most people come to this when they start thinking about, is there a way that I can save some taxes?
Mm-hmm.
Which I think just about everybody talks about in March and April, or maybe September, October, if they're normal extension people. But, but that's when people start thinking about, wow, I'm going to write a big check. Is there anything else I can do here where I don't have to write a big check? Can I write a smaller check? Most conversations are, I don't want to write any check, but,
Right.
Everybody's going to write something. So, I think that's where the conversation can start. because generally it's going to start from a tax standpoint. And if you think that your business is, I don't want to say complicated enough, but if you just have a regular small business that's running and paying your bills and you're making the money you're supposed to make, and you don't really have the aspirations of I want to grow or I want to make it into something else, you might just want to leave it alone. You know, we always use the KISS method, keep it simple.
Right.
But, don't make things harder just to make them harder. Don't make them harder so you save on the taxes, but you just paid the tax, planner or the tax person. Don't pay for something because you can't buy a tax deduction.
Right.
It's something that's natural and you put it together. Entities can actually change things where a C Corp used to be taboo. Because in the past, everybody would say, if you're not going public, don't worry about a C Corp, don't do it. Okay? The tax rates were 35% then. The top tax rate on a C Corp used to be 34, and then it would jump to 35 if you were over a certain dollar amount.
Mm.
So now they're flat tax at 21. So that rate differential changed the whole conversation. We don't say C Corps are out, don't do a C Corp. We just talked about a company that's relatively small that has a C Corp in their structure so that they could pay their people better and get better benefits for the owner. Never would have had that conversation 20 years ago. You would have said C Corp's it's not gonna work. It's just gonna cost you too much money. So, on top of the fact that a C Corp is just structured different, you have to have that workflow because too many people say, oh, my guy told me to be a C Corp, and then they go and they pull money out.
Right.
It's generally taxable when you pull money out of a C Corp. It's a dividend to you or it's a salary. I saw one the other day where their bookkeeper was treating everything as a distribution, which is what you would see in an S Corp or an LLC. And I'm like, that doesn't work for this. How do we fix that?
Right.
So you really have to kind of just know it. It's not that you have to be a tax guy or you have to become a lawyer. It's that you have to understand your own situation and why you're doing it. And if someone just tells you to do it and you do it, that's not a reasonable, piece to this. I would say your biggest piece to this is understand your company, run your company, and then use those pieces of advice for you to take advantage of, setting up a structure that's going to work better for you. One more example. I know I'm not letting you talk at all.
No, that's fine. Keep going.
So the other example was something I saw, which was new to me. Someone bought a company. They had raised $11 million, I think, and got the seller to give them a $2 million seller's note, which means you're going to pay them over time. So total purchase price in the $13 million range. And the attorney set it up so that all of the people that raised money for this are in an LLC. The LLC then owns a C Corp. And the C Corp then owns a single member LLC. And the single member LLC was the one who actually did the purchase.
Mm.
And I scratched my head and I had to think about this. I'm like, why would somebody at a $11 million or $13 million, raise suddenly goes out, buys a business for $13 million? And then the lawyers put together a 3-tier structure. Why? It's because the intention for them is to actually use this new qualified small business stock or this expanded qualified small business stock concept that says if you're going to buy a business or build a business that you start up the C Corp, that C Corp can grow to $75 million of value, and you can sell it if you hold it for more than 5 years. You can sell it for no gain. That is entirely a tax structure. That's entirely a tax plan. That if you know this is going to grow and that's your plan, you use a C Corp for that. And you have to pay tax on that as it makes money. But This structure allowed it to be where that disregarded entity, right, was the purchaser. If something fails, they can sell that off and they can maintain that 5-year timing, right? They have to hold the C Corp for 5 years, but if this business doesn't work out, they could sell it and still be within the 5 years and still working towards that 5-year sale. So the structure was not about taxes. It was about flexibility.
Okay.
Which I had not seen in the past. At least I saw it as flexibility from the accounting standpoint. The lawyers may have a whole list of other things in their folder that I haven't seen.
Right.
But the first thing I saw was flexibility. If you have to get rid of that LLC, if the business doesn't work and somebody else offers to sell, offers to buy it from you, you're not ending your goal towards this $75 million, growth plan and
right.
tax-free plan. So I was amazed to see that, because that was the first time in a long time that I've seen real ingenuity in the tax structure.
Now, maybe the best way to approach this from a very basic standpoint for this podcast is, what basic questions as a business owner should you be asking yourself if this makes sense, if this type of structure makes sense, whether it's what you just talked about or whether it's a holding company structure? What things should you start looking into? Because I'm guessing most business owners are going to, their eyes are glazed over when they're hearing you talk about this. But at the same point, they should be thinking about this in a way that might make sense to them in the future, especially if they are planning on growth. And we're going to assume that most companies do plan on some level of growth and succession. And we'll get into maybe more detail on how we can help them with that in the future. But, should there be 3 to 5 basic questions you should start digging into as you're going through all this to see, does it make sense for me to just be a S Corp, LLC, maybe a C Corp in some rare circumstances, or should we look at a multi-entity structure?
Okay, I think I'll put it in this way. Vast majority of people will some point in their business growth will come to the point of having that LLC versus S Corp question. And the difference, at least at the lower level, comes out to self-employment tax.
Right.
One's subject to it, one's not. And that there's quirks to that, but that's generally down to the basics. And if you watch social media, everybody will tell you, if you're not operating as an S Corp, you're giving away money.
Mm-hmm.
Okay. The fear tactic, the threat. Okay. You're not necessarily throwing, all of your money out the window because you didn't get the right planning. Okay. But don't go by social media.
Right.
If that sparks something for you, if that's applicable, call someone or get a recommendation for someone. Ask for someone that you can talk one-to-one on, because your situation is different than even the guy that wrote that social media.
Right.
So call someone and ask. Okay, when you ask that question, act like you're at the doctor's office and you're asking them, what's wrong with me? Okay. And they say to you, you're going to be fine. Take these pills. The question nobody seems to ask is, what are the side effects?
Yep.
Okay. And I want you to do the exact same thing. When this person that you trust says to you, you should be an S Corp or you should be an LLC, number 1, ask why. Number 2, ask what are the side effects. Okay. The difference that I'll tell you without glazing your eyes over is, you look at an S Corp and there's limits. There's limits on what you can do. You can't say, well, we just want to be nice and flexible. So John's going to get $1. We're going to give $50. John doesn't want the taxes, but he's going to own 50% of the company and we'll only give him $1. You just voided the S Corp anyway, and then you're not an S Corp.
Right.
Because you just basically tried to allocate in a different way than you're allowed to. Okay. So you have to know what the other rules are. The social media is only talking about one of probably a dozen, okay, differences between the two entities. And everybody runs to that first one because it saves them $50,
Right.
you know? So don't just chase the dollar, ask the side effects.
Right. Um, One of the things that I want to kind of bring up here, because I think this relates to maybe the earlier podcast we did about multi-structure that you kind of alluded to here, is, you know, when you're looking at that multi-structure, how big is the organization already? Can it afford the complexity that you're trying to add to it? And back to your side effects example, does that justify making the change? Because initially in the company that we were talking about, that we've been working with on this, they didn't have it's not that they were a small company, but they didn't have that volume where the trade-off between what it's going to take to now add another tax entity that you have to provide documentation for and compliance issues and all this other stuff, the two things didn't really offset each other. I think also in what I'm hearing from you is if you're looking at maybe multi purchases, so a acquisition of businesses, it almost seems like a multi-entity might make sense in a couple different ways as well. Is that correct?
Yes, I would absolutely believe that. I mean, you know, these structures have opened up the door to things that were previously allowable in one certain way that are now allowable in another. Or allowable might not be the greatest word. Maybe it's just the efficiency has gotten better.
Sure.
I mean, essentially, the entity we're talking about is a couple of similar groups or commonly owned groups that are now using a common resource for paying their people.
Right.
Well, that's just a small PEO, which is a professional employment organization.
Yep.
And that has been a health insurance plan for a long time. That, hey, if we combine companies to use us as a PEO, all of our benefits go through one company and we can get better rates from the insurance companies.
Right.
So it's not really all that new of a concept, except that other things now make it more efficient. You know, we've inserted a C Corp where 20 years ago you never would have put a C Corp in there because you never would have said, I risk paying 35% taxes.
Right.
You know, so now it's only 21. That becomes, is it more efficient? Is it a way we can do this? You're 100% right? There's administrative costs with filing another tax return, you know, running that company in a way that, you know, makes it efficient, you know, makes it so that you don't have to go back and, you know, scramble and put everything together. I mean, technology has helped, but in the past, you know, one company, you get to the end of the year, it's like you had to set aside a weekend to go into your shoebox and pull out all the receipts that you saved over the course of a year and add them up for your accountant, right? Now
Yep.
people are using, you know, QuickBooks and Ramp and all these technologies that have come out over the course of that 20, 30 years. And most of that stuff is done quickly. There's a piece of your efficiency why it doesn't necessarily cost as much. You know, but 30 years ago, if you went to your accountant and you had, you know, a shoebox full of stuff and told him to go through it, how many thousands of dollars did you have to pay him to go through that?
Yeah.
You know?
Well, I just think about my own experience even 20 years ago. You know, you talked about some of the software that you're using, but it wasn't until really more recently that software would link up with your credit card, for example. So you could just download your purchases and then you could go through and assign them to accounts and whatnot, which I remember going through line by line on my credit card statements and having to enter that in. And then, of course, you know, ultimately, when you have like 50 transactions, you're going to screw one of them up. And then you have to go back and spend another hour going through and figure out which one you transpose the numbers to.
Oh, 100%.
Yeah. You know, something else that kind of popped up as we're sitting here talking about this is maybe something to look at, because this is actually the company that we've been talking about, you know, why they initially probably shouldn't have done this. Now it turns out that actually there might be a benefit to them having done this multi-entity structure, which is the owner wants to retire in the near future. And trying to figure out a way for him to do that made sense, that still allowed him to build his retirement up or build value in the company. This has now worked out to be an advantage, not a liability. And on top of that, the other thing we haven't really talked about is economies of scale. So you talked about the employment side of things, but now if we look at it that there's a single holding entity and then there's entities underneath it that are similar but working individually, you can have that singular entity making purchases, buying equipment, buying supplies, not just the employment side of it. And same rules apply. If you've got higher volume going through, usually you're able to negotiate better discounted rates or prices on materials that you have to use anyway. So now you have these separate entities underneath that are all working individually, but ultimately the singular entity is providing everything from administrative support to cost savings to whatnot. And that's another reason where maybe looking at multi-entity does make sense as well, correct?
Oh, absolutely. And then you have another option there that, where does the C corp fall in? Can you still use an S corp in the middle?
Right.
In some ways, we talked about the mothership concept. Never said anything about what entity was the holding company.
Yep.
Right. I mean, we know that all of the LLCs make sense at the lower level. All of the pieces that are actually operating are at an LLC level because they just collapse into the holding company. But what structure is the holding company?
Right.
Right. I mean, if we're using that concept for real estate, you're probably still using another LLC, and all the LLCs collapse into an LLC. Why? Number one, you want flexibility, and number two, you don't want the assets to grow within an S corp and then try to restructure later.
Right.
Because the S corp has another rule, that essentially tells you that if you try to distribute out a piece of property that has appreciated in value, the S corp treats it as a sale.
Mm.
So you might say, hey, I'm just going to restructure. I'm going to put that building over here into this other entity. And the IRS is going to say, here's my hand. Put some numbers in it.
Right.
So that's where, structure counts. And even at the holding company level, structure counts. In our example, I think you're 100% right. Economies of scale is where this is going to benefit him. And I think that there was probably a conversation somewhere along the line that talked about the fact that as you grow, but I don't know that isn't the part that kind of got swept under the rug a little bit.
I think in this particular case, it was the potential tax savings that he was going to see. And that's initially what he saw when the structure was brought about. And I believe the person that brought the idea of the structure into place at the water cooler didn't really mention the other potential benefits because in the owner's mind, that wasn't his focus. His focus was, how can I minimize my taxes, put more money away for retirement, and get prepared to exit this business in the next couple of years. And now we're in a situation where, okay, he wants to exit the business, but we have to build enough value in the business that's a sellable entity. And part of the challenge is he needs more professionals in key roles to make that work go. So now we're sitting here, and this is where you and I were scratching our heads on this on Friday when we were talking about this after the podcast, is, okay, now we've kind of tripped into this situation where now this multi-entity thing actually could pay for itself in spades, because ultimately he doesn't want to be doing the physical labor anymore. He wants to step back, and this gives him an opportunity to move to administrative role and manage the other entities underneath and potentially fill those entities with professionals that would actually do the physical work in each of them, which is a completely different mindset than what we initially started with, because he more or less came to us and said, hey, I bought into this structure. How do we make it work? That's kind of where we were left. And that's where we were kind of scratching our heads, figuring out how we're going to help him recover the cost of what he did to do this. And I think that's where it gets critical for an organization to really look at what really makes sense. So back to your medicine example, there's certain benefits to anything that you take. There's also side effects come with it. And if you ever watch these commercials, they very quickly list the side effects on top of all the benefits because legally they have to. But at the same point, you don't really, as a client of a physician, often dig into what the side effects are. They kind of get glossed over because you're focused on the benefit side.
Yeah.
And to me, that's where, now I'm going to plug in our shameless self-promotion here. We do that 20 questions survey. And to me, this again is a perfect example of where you have a professional come in and challenge you on certain questions or ideas to help see if this makes sense or not. And having an outside person or group of people that know what's going on and get a clearer understanding of what you're trying to do can help make better recommendations on if this is something you should do or should not do. And to me, that's where the advantage is and where it makes sense to make that kind of investment. Rich, if they were going to get a hold of you to try and figure out how to do this, potentially using our 20 questions approach, what's the best way to get a hold of you?
Send me an email, rich@xcxo.net.
And you can get a hold of me at dan@xcxo.net. We would love to do a 20 questions for you, especially if one of the questions is, do I need to be a multi-entity or not? Or is my current corporate structure right or not? I think we can answer each one of those. So Rich, as always, a great conversation. And I'll allow you to get back to your taxes now. And let's talk again next week. Sound good?
Sounds fabulous.
All right. Away we go. Take it away, Bob.
Thanks for listening to Books and the Biz. If today's conversation sparked new ideas for your company, the team at XCXO can help you turn those ideas into action. XCXO brings together seasoned executives, fractional CEOs, COOs, CFOs, and CXOs who step into your business with the experience, strategy, and leadership to drive real results. Whether you're trying to scale, strengthen operations, improve profitability, or prepare for transition, our experts help you move faster and lead with confidence. To learn more or start a conversation, visit xcxo.net. That's xcxo.net, your shortcut to stronger leadership and a better run business. Thanks again for joining us. We'll see you next time on Books and the Biz.